As we get back to our panel for some reaction, Claudia, you were the one who said 50 basis point cut, and that's what happened here. Clearly, maybe more emphasis on what's going on in the labor market than on inflation.
Right. This is absolutely a vote for the dual mandate. And so trying to protect maximum employment. You know, things are good right now. They're not pointed in a good direction with the labor market, but that's why you get out ahead of it. So this is a risk management, and it's showing that the Fed is taking the risk on the labor market side very seriously. And that also shows up in the projections, right? They are trying to move. This is not the last cut. So it's a really important recognition of what we've been learning about the labor market, and the Fed is reacting.
So, David Kelly, they're opening big, and you think that another you said that by the end of the year we would be 3/4 of a point lower than we are today. That would imply then that there would be two more cuts of 25 basis points, or at least one.
Yeah, no, I think we probably will get two at this stage. I mean, I would have preferred they went 25 basis points today. Obviously, it's a very close call in futures markets. But the important thing to recognize is that cutting interest rates at the start doesn't stimulate the economy at all. There is a J-curve effect. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they really should be, but that's the message it gives, so it undermines confidence. The reason I thought, bringing rates down from a high level is like, bringing a piano down a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it. And I'm a little worried that they've started off in a rush here. But I do think this economy is strong enough to deal with it. I think we will, next year I think we'll get 2% growth, inflation 2%, unemployment close to 4%. So I think it's still a healthy, strong economy.
Does it risk it in any way, Jim, reigniting inflation?
Look, I mean, to some degree, it certainly could, but it really depends on what happens to the labor markets. Look, I see this as a three-dimensional problem for the Fed. Number one, where do they see the neutral policy rate being? Number two, how quickly do they want to get there? And number three, what is the employment situation? Is the employment situation going to deteriorate more quickly? What the Fed is signaling today is that they are very concerned that the unemployment rate could start to accelerate higher. So to me, yes, this could be something that might unanchor inflation. I think it's way premature to say that. I don't think that's what's going to happen. But what it does signal that they are worried that there could be a faster pace of layoffs and job losses and things like that. So I think the markets, while they may be happy that the Fed cut interest rates, they might have to ask the question as why they're going as fast as they're going and what is the cause for that concern. So I think it is a little bit of a double-edged sword here.
Claudia, what about that very interesting point that David made, and that is that perversely, sometimes cutting interest rates can slow down activity as people wait for interest rates to go even lower?
Right. Well, the first thing I'd say is we know from this cycle already that the comparisons back to history are going to be really tricky. We haven't had a kind of easing cycle like what the Fed has started us into in a very long time. So and we've had a lot of what are Fed interest rates even doing in this cycle. So I think there is that issue. Now, markets, and this will be a very important part of the press conference today, is this messaging from Powell about going forward with interest rates. You can get that quote unquote forward guidance and have the market rates look out ahead. And this is a Fed that with a 50 basis point said we are going to do this and we are going to be not necessarily aggressive, but we're really going to move on it. And I think that can show up in market rates and then help with that, behavior changing.
David.